In last week's video, I talked about the first 5 steps of the FIRE checklist from calculating your FIRE number to maxing out the emergency fund, and you can check out that video in the description below. If you're brand new to my channel, my name is Sai and welcome. You're watching part 2 of the 2-part video series to dive deep into my FIRE checklist and how you can achieve financial independence and retire early. Step 6 of the FIRE checklist is to max out your contributions to your Roth IRA and HSA. Let me first talk about the Roth IRA. You can either contribute directly to the Roth IRA or do a backdoor Roth IRA, and it depends on your annual income. And if you're under the income threshold set by the IRS, then you can directly contribute to your Roth IRA from your checking account. And if you're above the income threshold, then you can do what's called a backdoor Roth IRA by opening both traditional IRA and Roth IRA, and I will link those videos in the description below. You should understand the differences between the two and how they will affect your taxes for the year. The Roth IRA is your core retirement account. Your 401k or TSP is only active as long as you're employed with that company, and your Roth IRA is yours to manage for the rest of your life, and you have the option to roll your 401k or TSP retirement accounts to traditional and Roth IRAs if that's what you choose to do. What you directly contribute to the Roth IRA is already tax-free and penalty-free. You can take out your contributions at any time. The earnings and interest are what you need to wait until you're 59.5 to withdraw from your Roth IRA. If you converted any money from your traditional IRA, then you'll need to wait a minimum of 5 years to withdraw from your Roth IRA. I would highly recommend keeping a detailed record of your contributions and conversions so you can separate the two. With the Roth IRA, you have several investment options. I can't personally tell you what to invest, but here are the most common investments you'll find. You can keep everything in cash inside your Roth IRA, or invest in actively managed mutual funds, index funds, ETFs, individual stocks, or bonds. And if you want to go with the lazy route, there are always the target date retirement funds based on your retirement age. Investing in your Roth IRA is a crucial component of your financial independence journey, and your Social Security retirement is most likely not going to cover your entire retirement expenses. And having your money grow tax-free could significantly reduce your taxable income in the future. And just by maximizing your contribution to your Roth IRA every year starting at age 30 with a 10% average annual rate of return, you're looking at over $2 million invested tax-free by the time you turn 60 years old. And if you're married, you can contribute in 2 separate Roth IRAs, and you could possibly have double the investments by the time you retire. And I strongly encourage you to check out this video about how to become a tax-free millionaire with a Roth IRA, and I will put that video link in the description below. And the next one is maximizing your HSA or health savings account. And not everyone is eligible to contribute to the HSA if you don't have the correct healthcare plan. And HSA is another important part of the FIRE journey because not only it can help you with your medical, dental, and vision expenses, but it can also become a part of your retirement income. What you probably didn't know is that you can actually invest money inside your HSA into a mutual fund, and there are no income limits to having an HSA. However, you need to meet the following criteria to open one. You cannot be enrolled in Medicare or TRICARE, be claimed as a dependent, and you have to meet the minimum deductible for an individual high deductible health plan or the family HDHP. You should check with your employer to find out if they have the HDHP available to you as an employee. The HSA is a triple tax advantage account to allow you to contribute in pre-tax dollars, which lowers your taxable income. And don't get this confused with an FSA because that's a spending account. The best way to do this is to work with your employer's HR to have your paycheck deducted so you can decrease your taxes, instead of waiting around until the following year when you file your taxes with the IRS. Also keep in mind that your employer could give you the match to your HSA, and unlike the 401k, the employer match will count towards your personal contribution limit, so you need to be careful with that. For example, if your contribution limit is $7,500 and your employer contributes $500, then your contribution limit is $7,000 for the year. The HSA can also grow your investments tax-free, and I'm going to use my Optum Bank as an example here, but you should look at your own HSA and find out what investment options they have available to you. I have all kinds of mutual funds that are available to me with my HSA, and I can do the target date retirement fund with Schwab, Vanguard index funds with like the S&P 500, REITs, and small cap and medium cap mutual funds. And I'm not going to tell you what to invest, but having a 10% average annual rate of return for an individual HSA fund starting at age 30 for the next 20 years is $300,000. And even if you stop contributing after 20 years, your HSA could grow to almost $1.3 million by the time you turn 65. The average medical cost for retirees per couple is about $300,000 throughout their retirement in the US. If you have the family HSA, then you could have over $500,000 in 20 years and almost $2.4 million by the time you turn 65. The other advantage that HSA has is it allows you to withdraw from it tax-free if you can provide medical, dental, and vision receipts. And there's no deadline on these receipts, so you can get a medical treatment today in 2022 and then reimburse yourself 20 years from now in the year 2042. It's completely up to you. When you turn 65, however, you can withdraw from your HSA without providing any proof of medical expenses, and you would just have to pay the income taxes that are applicable to you, and the 20% penalty tax is completely waived. I strongly encourage you to check out this video about the HSA, and I will put the video link in the description below. Step 7 of the FIRE checklist is to max out your employee retirement contribution, and I'll break it down between two scenarios: self-employed and employed. If you're employed, then the most common retirement account is the 401k in the private sector, TSP for federal employees and members of the armed forces, 403b for public school teachers or other nonprofit organizations, and 457b for state and local government employees. Now, your employer's retirement plan isn't structured the same as everyone else's, but I'm going to give you broader information on what you're supposed to do on this step. The first thing you need to figure out is if your employer's retirement plan offers the Roth option. And if they do, then you need to decide whether you want to contribute to Roth or traditional. And with the Roth account, you're contributing your after-tax money or the money you already pay taxes on. Because you already pay taxes up front, you can withdraw it tax-free once you're eligible to withdraw from your retirement account. With the traditional account, you're contributing your gross income or the money before it gets taxed, which means it will lower your taxable income. Using the traditional route means you're going to pay taxes later when you're eligible to withdraw from your retirement account. And the next thing you need to know is what the limit is for your personal contribution. Your contribution limit begins on January 1st and then ends on December 31st. For the year 2022, the contribution limit is $20,500, and if you're age 50 or older, it's $26,000. And the contribution limit will increase over the years to adjust for inflation set by the IRS. If your employer gives you a match, like I talked about in step 2 of the FIRE checklist, that employer match does not count towards your personal contribution. So if you contribute $20,500 for the year and your employer contributes $5,000, then you're contributing a total of $25,500 for the entire year. However, the total contributions between an employee and the employer cannot exceed $61,000 for the year 2022 or $67,500 for 50 or older. Your investment options may be limited inside your 401k, 403b, 457, and TSP. You can always be more hands-off by choosing the target date retirement funds, or what I call invest and forget. What you really want to look for inside your 401k, and this is not any specific investment advice, is to look for the 5 and 10-year historical returns and the expense ratio, which is the cost to hold an investment fund for a year, and they charge you a certain percentage of the money invested in the fund. You probably would want to invest in something that's giving you a 5 to 6% return, and the fund charges you a 1% in expense ratio, right? You should assess your risk tolerance and financial goals to know how much you want to be exposed to stocks versus bonds. And I've made several videos about the 401k investment options, and I will link those videos in the description below. If you're self-employed, you have several retirement options. You can do what's called a solo 401k, which allows you to contribute as the employee and the employer and gives you a higher limit than other retirement plans. You can also set up a SEP IRA, which stands for Simplified Employee Pension for sole proprietors. And this plan is only for employer and not for employees. You can contribute up to 25% of your net earnings and not exceed the annual contribution limit. And if you're running a very profitable one-person business, then the SEP IRA might be the right one for you. And you can also do a simple IRA, which is the same thing as SEP IRA, but with a lower contribution limit. Make sure to explore all of your self-employed retirement options and the tax benefits before you start contributing to one. Step 8 of the FIRE checklist is to achieve at least 50% of your savings rate. And by the time you reach this step, you're already maxing out your Roth IRA, HSA, and 401k, right? If all of the combined is not quite 50% of your income, then you want to consider opening additional accounts to get to your 50% savings rate. The easiest way to calculate your savings rate is by using your gross income, not your take-home income. And for example, if you make $150,000 a year in gross income and you're saving $75,000 a year, then that's a 50% savings rate. Simple, right? The take-home income is much harder to calculate because you don't really know how much you're paying in taxes until you file your taxes in April. And achieving a 50% savings rate of your gross income is much more challenging than the net income. Here are some tips to save half of your income. And if you're in a dual income household, try to save one income and spend the other one. You can also open FSAs or flexible spending accounts that could lower your taxable income. The common ones are the Healthcare FSA, Dependent Care FSA, and the Limited Purpose Healthcare FSA. You can check out that FSA video linked in the description below. If you have children, then consider opening a 529 plan to save for their K-12 or college expenses. You can also gift your children by opening UTMA or UTMA or UGMA UGMA accounts. You can also open an additional investment account or the taxable brokerage account. There's a long list of stocks, bonds, ETFs, and mutual funds that you can invest in your taxable brokerage account. A lot of people on the FIRE journey just choose to invest in index funds like the S&P 500 to keep things simple in their investment accounts. Even if you have a higher risk tolerance, you should still be careful not to put all your eggs in the same basket. You should look at the long-term outlook of your investment portfolio. How much is $20,000 a year with a 10% average annual rate of return going to give you in 20 years? And what types of investments get you an average of 10% return? My wife and I have 2 taxable brokerage accounts. One account tracks dividend investing and the other account tracks growth investing. You can check out my dividend investing video linked in the description below. If you have a high income like $250,000 or $300,000 a year and your employer offers what's called an after-tax employee contribution to your 401k, then you could do what's called a mega backdoor Roth. For example, if you're 40 years old making $300,000 a year in gross income, you max out your retirement contribution at $20,500 and your employer contributes, let's say $7,000 a year in your 401k. For the year 2022, since your maximum contribution to your 401k is $61,000, then you would have $33,500 left to contribute as a mega backdoor Roth. You just need to make sure that your 401k plan has the in-plan rollovers to a Roth 401k or in-service withdrawals to a Roth IRA. The process can be quite complicated, so you need to make sure that you do this right and get with your HR and the 401k brokerage company to make sure that they have a process in place. Step 9 of the FIRE checklist is to build generational wealth. And you can arguably put steps 8 and 9 together, but I wanted to separate them for several reasons. When you're in this step, you're most likely very close to the financial independence stage. And what my wife and I are building now can be passed down from our generation to the next generation. Generational wealth can be our cash, investment funds, properties, and businesses. We want to create a legacy that my previous generations couldn't do in the past. You should have a conversation with your spouse to create an estate planning in case one of you passes away. And it's extremely important to have a last will and testament set up for each of you, regardless of your age, so the survivor knows what to do in case of an unexpected death. If you're a high net worth individual, you should consider forming a trust to have more control of your assets in the event of your death. You should designate beneficiaries for every bank account, investment account, and any properties that you have under your name. The last thing you want to do is for your family to fight over properties in probate after you pass away. And there will also be challenges if you blindly pass your wealth to your kids and grandkids. You should help your kids invest in financial education. And teaching your kids about personal finances is a form of building generational wealth. And you wouldn't want your children to receive millions of dollars in inheritance when they don't have a single clue about how the stock market works, right? You wouldn't want to pass down your business to your kids if they don't know anything about how your business operates, right? I would encourage you to have a conversation at least once a year about your estate planning so your beneficiaries are aware of your wishes. And lastly, be generous and give back to your community. And I want to be generous by giving my time to volunteer in the community. I want to be generous by paying for someone else's food in the drive-thru. I want to be generous by paying for someone's groceries in the grocery store. I want to tip $1,000 and more to a restaurant worker and expect nothing in return or recognition. And it gives us a sense of value and purpose instead of hoarding our wealth to ourselves, right? I've struggled financially in the past, and I want to be able to help others who may be in the same struggles I had. And I want you to ask yourself, how do you want to be generous when you have the extra income? And you don't have to wait until step 9 of the checklist to be generous, but you should wait until you're at least debt-free and have a fully funded emergency fund. And step 10 of the FIRE checklist is to pay off the mortgage. Now, we have the traditional argument of whether you should pay off your mortgage or invest. It's ultimately a personal decision and up to your risk tolerance. Having a mortgage on your home is different from having a personal loan, student loan, or credit card debt because your home is an appreciating asset. And the math tells me investing instead of paying off my mortgage early makes more sense. However, if my wife and I are close to our retirement age and we would like to be more risk averse by paying off our mortgage early, there's nothing wrong with that. And since we're in our mid-30s, we wanted to focus on investing so we'll have enough to pay off our mortgage at any time. We would also put interest rates into our consideration. We refinanced our current home to a 2.9% interest rate, and I'm not sure we'll see that ever again in our lifetime. If our interest rate was above 6%, then we would most likely pay off our mortgage as early as possible. And we will also like to pay off our mortgage when we're in our 50s to be more risk averse. We also don't want to tie up too much liquidity in real estate, and this is why I prioritize investments from steps 6 to 9 of the FIRE checklist. And we want to make sure we have our emergency fund, retirement fund, and other taxable investment accounts invested so that we don't tie up the majority of our net worth in real estate. When we're truly ready to retire early, we want to make sure it makes sense to us to pay off our mortgage early by either making additional mortgage payments or cashing out some investments to pay off the mortgage in full. Either way, it's not an easy question to answer because it depends on your financial situation. So those are the 10 steps of financial independence that my wife and I are following to retire early. Let me know in the comment section down below if you have any feedback on the checklist. And if you want to know more about how to invest for your early retirement, you should check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.